Hi, I'm Lia.
And I'm AK.
And this is our channel where we talk about property investing, business, and working together as a couple.
Now, a lot of people message us expressing their interest in HMOs, followed by many questions about whether they work and if they are good investments. So in this video, we are going to look at HMOs and in particular, whether they still work in 2024.
As you might know, a HMO is a house in multiple occupation, otherwise known as a shared house, or sometimes referred to a house of multiple occupancy.
Now, we want to be clear that HMOs are not for everybody, and they do have a bit of a reputation as being more difficult to do than some other property strategies. For one, they need more capital investment, along with needing more time to manage them.
And of course, there are more rules and regulations around them than ever before.
So, does that mean that they don't work as an investment anymore?
Well, we actually think that 2024 is a brilliant time to be investing in HMOs. And in this video, we're going to be telling you why.
Firstly, demand for shared accommodation is huge. Now, this has a lot to do with the housing shortage and, of course, the cost of living crisis.
Yeah, rising rents mean that even people with pretty well-paid jobs can't afford to rent a whole place themselves, let alone buy one.
Now, the average UK rent is £1,294 a month, according to HomeLet. Now, that's over £15,000 a year. Ideally, you need to be earning £38,000 plus a year in order to afford that.
But the average UK income is under £35,000 per year, according to official stats. So that's where it starts to get a little bit tricky.
Now, HMOs are, of course, a very affordable option, making them more popular than ever in 2024. It's pretty standard practice as well for HMOs to include bills, making them even more attractive to renters.
And we need to mention the student market too. HMOs have long been popular with students, but many university cities actually have a shortage of accommodation. According to StuRents, there is a shortage of over 283,000 student beds across the country, with places like Bristol, Manchester and Glasgow really badly affected. There will be a shortage of a whopping 620,000 beds by 2026. Which is absolutely crazy when you think about it.
So if we put our investor's hat on right now, this looks like a very big opportunity. And of course, demand levels are different in different places. You always need to check demand before investing in a particular area.
Next, it's not just about affordability. HMOs are a very popular lifestyle choice right now too. Shared accommodation fits in very well with a lot of today's lifestyles. Sharing a house with a friend can be loads of fun. I know that you've lived in shared houses, I've lived in shared houses, and I think it's all pretty linked in with that student market. Many people share a house with their friends at university, and then when they leave university, they want to carry on sharing with people for a few more years before they perhaps fly solo or maybe move in with a partner.
Yeah, Leah was saying earlier that it's not so fun sharing a fridge.
It's not.
Well,
it's fun sharing a house, but not a shelf in a fridge. It's just not fun.
And there's another important factor too. Today, a lot of people work on short-term contracts, or perhaps they work in one place during the week and then they go home at weekends. And I know when I was working in the corporate world, moving from job to job, I used HMOs in every city that I lived in. And they were absolutely perfect for me as I was single at the time and I didn't want to pay for a whole flat, including additional costs such as bills and furniture.
Especially since you were driving up to the Midlands every weekend to see family.
Exactly. So I was back and forth a lot. So HMOs for me were absolutely perfect.
And you were absolutely single. You never actually had any visitors in any of those homes at all.
One pillow.
In 2024, the numbers behind HMOs still stack up really well.
It's not just living costs that have skyrocketed recently. Overheads like maintenance and running costs, as well as interest rates, have also gone up.
Some of our bills for a 4-bed property can be as high as £650 per month. But because HMOs bring in more rent than a traditional buy-to-let, they can still be profitable even with those higher overheads.
Now here's a simple example. A single family buy-to-let in one of our investment areas, say a 4-bedroom terrace house, might bring in around £900 a month or £10,800 a year. But the exact same property let as an HMO at £130 per room per week might bring in over £27,000 a year.
And you may have seen our video called How Much This 120k Investment Property Makes, where we break down all of the numbers on one of our 4-bed HMOs. If you haven't already, you can watch that afterwards. More cash flow is always going to be a good thing in property because you can use it to expand whilst borrowing less. And in times when interest rates are higher, this is really handy.
And that brings us to the subject of yields. Now, as you might know, yield is all about how much return you make on the money you put into the property. Now, this is a gross figure calculation, but it's a great indicator of the rent to property price ratios as well. And yields are always bigger on HMOs.
So let's say a single family buy-to-let gives you a 5% yield. That's okay. But a good HMO might bring in 10, 15, or even a 20% yield, and that would be classed as a great return at the moment.
Now, if you are wondering how to work out the yield on a property, or the ROI, which is the return on investment, then you can watch our video here where Lia teaches you how to do those calculations.
Ta-da! HMOs offer incredible potential to add value. So adding value to your investment property is important in times when prices aren't booming because you can't rely on those rising prices alone to grow the value of your portfolio. So what do we mean by adding value?
So basically improving or converting the property to make it worth more than the cost of the property. So that might be the purchase and the renovations to that. Now, what we do is we buy rundown houses and we convert them into nice HMO hotel type rooms with their own en-suites in them. This, of course, increases the value of the property and therefore allows us to refinance them once we've completed the project, which allows us to be efficient with the funds and recycle some of that cash into the next deal.
So you can find out more about these in our other videos, which I will link up in the cards.
And finally, prices are looking very attractive for HMO investors in 2024. This, to us, is one of the most exciting things about HMO investment right now.
So after several years of fast rising property prices, house prices across the country are now pretty much static and some are falling. According to the latest official UK house price index, prices fell by 0.2% on average over the last year. And in London, they fell by 4.8%.
But according to HomeLet, rents rose 7.9% over the year. A property market where house prices are softening, but where rents are strong, looks like an amazing opportunity to us.
If you are looking to buy, then there could be a golden opportunity to jump in, as long as you understand and you are happy with the numbers.
And of course, that probably won't be the case forever, but it's why we think that not only do HMOs still work in 2024, but that is also a great year for HMO investment.
Now, we hope you enjoyed this video. If you haven't already, please remember to subscribe for more videos like this, and we will see you in the next one. Take care.
Bye.
Bye.